Good morning everyone. In this video, I'm going to talk about 3 most common ETF orders and what are the best ways to execute them and some tips when you should and should not trade an ETF. My name is Irene and let's get started right now. Many people may think that it's important to know the trading mechanism of ETFs and they just buy and hold at market price. But I believe understanding the fundamentals of orders, its liquidity as well as volatility are critical to boost our long-term return as well as managing our risks because every penny counts, right? So let's start with the 3 most common types of ETF orders. The most common order is the market order. Market order is the most simplest and efficient order type to execute your order quickly because your order will be prioritized. For example, you would like to buy ETF ABC on market order and currently the market depth is something like this. So in other words, you are in the market. While the market order is usually filled very quickly, we have to keep in mind that it's disadvantage as we accept the market price, we don't know exactly what price we will buy or sell the ETF until the order is executed. For an ETF, its market share price usually is very close to its fair value, the net asset value, the NAV. However, at times when there is temporary market volatility due to economy announcement or even one of the heavily weighted stock price tanked, the market price of an ETF can change dramatically. During those periods, a market order provides no protection to the investor. The second type is the limit order. Limit orders give us the option to set a limit on our buy or sell price. And these orders would not be prioritized as market orders because they sit behind the market prices. And the closer your limit order is to the market price, it's more likely your order will be filled as the market price moves during the trading day. The disadvantage of a limit order is that it is not guaranteed your order will be executed in full depending on the number of units that you're buying or selling, or your order might not be filled at all if your price is not competitive. Compared to market orders, limit orders can protect investors from significant change of an ETF's unit price due to unexpected market volatility. The third type is the stop loss order. First of all, not all the online brokers offer this order option as this type of orders are usually used by traders. And stop loss orders can help investors to reduce risk exposure or lock in a certain amount of profit in a trade. For example, I bought shares of ABC ETF at $30 per share and I put a stop loss order at $25 per share to limit my risk to a maximum loss of $5 per share. Once the ETF market price hits $25, my order would be triggered and turned into a market order. Therefore, it will be executed at the prevailing market price. I'll give you another example for locking in a profit. I have ABC ETFs that I bought at $30 per share and subsequently ABC rises to $35 and I miss the chance to realize the profit and soon the market price starts to fall, then I may enter a stop loss order at $32 per share to lock in the $2 profit per share if the ETF unit price falls back down to $32 per share. So there are 2 things that we need to be careful about this stop loss order. Number 1, the stop price you set is just a price to trigger the order. Once the order is triggered, your order will be market order. Therefore, the final price that you get could be significantly different with the stop price that you set in the rapidly moving market. For example, I have purchased ETF ABC at $30 per share. Now I placed a stop loss order at $28 per share. And the stock price closed at the end of the trading day at $31 per share. Then after that, there was some major political announcement on the news. And when the market opens, the next trading day, say this ETF opens at $18 per share, then my stop loss order will be triggered and it will be executed at around $18 market price. So we have to understand in some extreme circumstances like this, stop loss orders cannot provide much protection. On the other hand, your limit order is guaranteed to be filled at the order price that you set or better. The second point that we need to be careful of this stop loss order is during some cases such as rapid decline of share price and bounce back quickly, people call this situation a flash crash. During 24th of August 2015, index ETFs like SPY or Diamond, even VAS went for a deep dive within minutes and gained back most of the loss within the trading day. If you put a stop loss order during the temporary market volatility, the stop loss order will be triggered and the ETF will be sold low and then you would have to buy high if you want to get back into the funds. To prevent these 2 extreme events from happening to your order, you can choose to stop limit order, which allows you to put a trigger price as well as a limit price. So when the trigger price is reached, the order will be executed as a limit order instead of a market order. Like individual shares, we would like to buy at a market price that is undervalued compared to its fair value. For ETFs, the fair value of the unit price is NAV, net asset value, which is calculated at 4 p.m. Monday to Friday. Therefore, we want to buy at a market price that is very close to its NAV. However, ETFs are traded throughout the day, so there's always a discrepancy between the market price and its NAV. Sometimes the difference can vary by several basic points. If we can control our purchase costs as fair as possible over the years, that we can maximize our long-term returns. So here are some tips to help us achieve this. Number one, avoid trading during the 2 times during a trading day. The difference between an ETF's intraday price and its NAV is the largest at the opening and the closing of the market. Because at this time, market makers who set the market price are balancing their books and they're trying to rip you off, trying to get you buy high and sell low to make profits, which will result in a wider bid and ask spread. So the rule of thumb is to avoid trading in the first and the last 30 minutes of trading. So in Australia, restrict your trading time between 10:30 to 3:30. Okay. Tip number 2, use market order cautiously. When we accept a market order, we're willing to accept the bid and ask spread, which can widen significantly when the ETF becomes less liquid. Highly liquid ETF has narrower bid and ask spread and smaller discrepancy between its NAV and the intraday price. By placing a limit order with reasonable price limit can help us remove the possibility of the unexpected buy or sell price that we may end up getting. Tip number 3, don't trade during volatile periods. When the intraday price of an ETF is above its NAV, it's considered to be trading at a premium. When it's below its NAV, it's said to be trading at a discount. As an ETF is a basket of securities, the underlying securities liquidity can affect ETF's volatility. For example, when Chinese stocks are being heavily sold off this year, the MSCI emerging markets ETFs have suffered high volatility, leading to larger premiums and discounts. Tip number 4, only trade the ETFs that tracks overseas markets when the local market is open. So if you own an ETF that tracks an overseas market, it's best to trade when that particular local market is open. This will allow any new information to be reflected into the prices of the ETF's components and give the market makers to adjust their bid and ask spread. For example, Aussie investors of VAE, Vanguard, FTSE Asia excluding Japan ETF are likely to see narrow spread 12:30 p.m. onwards when the Asian stock market start to trade in the morning because of the 3 hours time difference. In reality, most of us adopt the approach of buy and hold long strategy, and we don't buy or sell ETFs so frequently, but I hope the tips that I mentioned today can help you understand ETF orders better and optimize your long-term return. Last but not least, don't forget to have a wonderful day. Give this video a like if you find it helpful, and don't forget to grab the 2 free trading credits from Perla by using my link. My name is Irene. I'll see you next week. Bye.